Good morning, good morning, good morning. Thank you so much for joining us today, where we're here to talk about building wealth, protecting what matters, and securing her legacy. It's a fantastic morning today, very, very sunny in Nairobi. Please do let us know in the chat where you're joining us from. Excited to have you on board as we tackle this incredibly important topic, which is your financial future. Today really is more about money. It's really more about choice. It's less about money, more about choice, confidence, creating opportunities for ourselves, and protecting the people that we love. Did you know that women outlive men by 5 to 7 years? That's an astounding stat, and that really gives us more reason to really pay attention today to drive our futures and take ownership of the future as well. I think naturally women are planners, and what happens in the process is that we forget to look out for ourselves, and therefore the question that here we really want to talk about is who is looking after your financial future? Who is planning your financial future? Women today are more and more empowered to bring in, to build their own finances. Actually, 72% of women in Kenya are part of our workforce, which is an astounding number. And as a result of that, we really want to ensure that we provide women with the tools and the confidence to be able to invest in your future. Unfortunately, what happens along the way is that women lose confidence when it comes to making investment and insurance decisions. And also, in terms of protecting your legacy, it's something that's usually left for another day. And so we really want to bring this conversation back home today. We have a panel of experts that join us to provide you and empower you with the information that you need. And therefore, allow me to introduce these experts to you. I will start off at the far right. And who we have for you today is the beautiful Gladys Mboya. Lovely to have you on board. She is the managing partner at Mboya Wangongu and Wayaki Advocates. She's an advocate of the High Court of Kenya, a commissioner for oaths, a notary public, and a certified public secretary, member of the Law Society of Kenya, the Chartered Institution of Arbitrators, and the Institute of Certified Public Secretaries. of Kenya. So those are a lot of accreditations. You have somebody who is a well-known expert in the area of estate planning to take us through this conversation. She is very passionate about that, and in particular, helping clients preserve their wealth and businesses for generations to come. Welcome, Gladys.
Thank you. Yeah. Hello, everybody.
Great. I will then move on to Julia, a colleague, the Executive Director and Principal Officer of Absa Bancassurance, Kenya. She's a seasoned and recognized financial services executive with over 20 years of experience in banking, insurance, and bancassurance. She's led the Absa Bancassurance business to sustained market leadership in Kenya, a graduate of the Harvard Business School Executive Education Senior Executive Program for Africa, SEPA, and very, very passionate about advancing insurance inclusion by combining practical experience with strategic insights to meet changing customer needs. Welcome, Julia.
Thank you, and good morning, everybody.
Fantastic. Looking forward to the discussion, Julia. And finally, not least, is Elizabeth Arungu, right on my right. She is the CEO of Absa Asset Management, decorated and seasoned investment manager and trained economist with over 20 years of experience in investment management and leadership. A chartered financial analyst with leadership roles in investments and financial analysts and fund managers associations, and a nominated member of the CFA Institute's Disciplinary Review Committee. Certified productivity and engagement coach, and very passionate about financial markets, economics, investments, tech wealth, ESG investment principles and investments, and enjoys writing articles and training in these areas. Welcome, Elizabeth.
Thank you very much, and good morning.
As you can see from the profiles that I've read out of the speakers today, you're in for a treat. You have accredited individuals and experts who are going to take us through and navigate this conversation with us today. And before I move on, I've just been reminded that I must also introduce myself. My name is Sima D'Souza. I look after the affluent business for Absa Kenya. I have been working for 28 years in the banking industry. I feel like a monolith in this space, and the retail and private banking space. Two-time, it feels so weird to read out your own profile, two-time service excellence leader, and currently the leading strategic growth and profitability of the affluent business at Absa Kenya. Usually, I introduce myself personally first, so let me introduce myself as a wife, a mum. I'm also a beautypreneur outside of banking, an avid writer. I love traveling, and I am an adventurist as well. My principle for life is live each day like it's your last. But that at the same day as I introduce that, live each day as it's your last, this conversation becomes more and more critical for us to have, because you never know when that last will actually be. So thank you so much for being here, esteemed panelists. Before we go into actually getting insights from the panelists, what I'd love to do is launch a poll, which you will see coming up on your screen. There will be 6 questions, and I will read through these questions. I encourage you to just go in and click on what is relevant to you. The first question is, are you currently investing in any of the following investment options? And you can see them up on the screen. SACCOs, money market funds, stocks, so in the NSC, into government bonds, offshore investments, and not yet investing. And that's also okay if you're not at that space yet. The second question is, what's your biggest barrier to growing your wealth right now? Is it lack of knowledge, limited income, fear of risk? Is it the lack of time in actually making those decisions, or none of the above? Third question is, what is the percentage of insurance penetration in Kenya? Multiple choice there for you. Is it 30%, 2.4%, 10%, or 16%? Have you reviewed your insurance cover plan in the last 12 months? Simple, yes, no. I've never reviewed it, and let's be honest, if you don't have insurance, that's also an option for you. Do you have a will or estate plan in place? Again, yes, no, and you've thought about it, but just not yet started. And finally, at what stage do you think estate planning should actually begin? Is it early in life? Is it when I acquire assets? Is it when I get married, when I have children? Or are you just not sure? And so if we can just go through the questions, starting from the top, the responses that we have here is, fantastic, Liz, money market funds seems to be doing well for us. At least we have some investments in that space. SACCOs still seem to be an area where people are investing, with the other options coming slightly lower. And so we could possibly unpack some of those today. If I could go to the next question, the biggest barrier to growing your wealth. Limited income and many responsibilities. I know, I feel you. I think the panel also feels you. Today we can just talk about some of the things that we can do to start investing, however small it is. Fear of risk comes up as the second one, so we can also address that in the webinar today. Percentage of insurance penetration in Kenya. Let's see this. Okay, 10%. 10%, and now it's growing. 2.4% seems to be matching up with the 10%. Julia, do you want to answer that very quickly right now?
It's 2.4 on the GDP.
2.4%, an astoundingly low percentage of insurance penetration. And so today we will equip you with what it is that you need to be able to start insurance and understand why it's so important. Have you reviewed your insurance cover plan in the last 12 months? Fantastic. At least we have 47% who have said yes, which is great. I do not have insurance as well, so we still have some women on the webinar who have not insured, and we'll talk you through the benefits of insurance and why it's something that you should do. And then going on to protecting. So do you have a will or estate plan in place? No, and thank you so much for your honesty, ladies. 51% don't have them, but what is encouraging is 36% of you have actually thought about it. So again, today we're going to empower you with information as to why it's so critically important to get this plan in place. And finally, at what stage do you think estate planning should begin? Early in life, that's great. When I acquire assets, 36% of you think that. 1% when I get married, that'll be interesting to unpack too. And when I have children, 7%. So again, today we will go through that and just share what it is that is required and at what point we need to get onto this estate planning journey. Thank you so much for your responses on the chat. Keep them coming, and also just to remind you, we do have a Q&A option there. Please post your questions, and we will hopefully be able to answer them throughout the session today. Right, so let's get into the meat of this, and I will start off with the first question, which is building wealth. And here we have Elizabeth, who is our technical expert, to take us through some of the tricks of the trade. And I'm going to ask you, Liz, when you talk about, and I saw some of the responses here around, not having enough information. What are the key pillars of successful wealth building, bearing in mind the economic shock and the crisis that the world is facing? We've gone through a lot of turmoil. How does that impact wealth building right now?
Okay, thank you very much, Seema, and good morning again. I think the first thing I'll start with is, as women, building wealth now is possible. There's a time women were not participating in the economic activities, and they were only contributing non-monetary type of labor. But today, our labor is paid. So most women, like you said, 72%, they're participating in the economic activities in Kenya. So we still have a good chunk of women who are not in, but let's speak about the ones who are making some money. So if you're making money, you already are one step ahead in your journey towards building wealth. But the mystery around wealth is that a lot of us believe that wealth is a term which is only for the affluent or the very rich. But I would like to demystify that and say that wealth is about your comfort. It's not a status that you need to reach, maybe dollar millionaire or something like that. It is living comfortably without worrying. And that means it can be at any level. It doesn't need to be at a certain stage. But definitely, when you have more money, it means that you have better financial muscle. So if you're building your wealth as a woman, let's appreciate that we also face more challenges than maybe our male counterparts. You're navigating more things. While you'll navigate COVID like every other man, you'll navigate Iran crisis just like any other man. As a woman, you'll also navigate gender pay gap, because that's real. It is still a big gap. The incomes that we earn as women versus what the men who are doing the same job as us are earning. So you'll have to navigate that. And of course, career breaks if you're a mom like I, and you said you're a mom. So definitely you had those breaks, and likelihood is they may have impacted your journey towards your wealth building, but maybe you did not even calculate that. So there's need to advocate more advocacy so that women are not disadvantaged. But let's take that aside, go to the fact that now you have made money. How do you then protect yourself and build this wealth so that you live comfortably? I'll talk about several things that you can do, and they touch on everything that we're going to talk about today, because it's not just having an investment account. It involves also insurance, which is protecting, involves legacy, thinking about the future, because it's not only for today. We have to think through our whole lifetime and post our life here on earth. So the first thing is your earning power. You've got to earn it before you can invest it. So well done, you're already earning something, whether it is through business, you're employed, your side hustle, whatever it is, you're good. So with that, your earning power, you need to continuously negotiate, continuously make sure that you're growing that earning power, because it is from those earnings that then you will spend, and ultimately you should be spending less than your earnings so that you're living below your means, and then therefore you have something to save. But we say that once you're earning, you have done your earnings, you have made your earnings, then your fasting is to pay yourself first. I know this sounds like it's so cliche and all that, but we like to really insist that you've got to put aside or pay yourself first. Being paid by your employer or by your hustle is one thing. Paying yourself by putting aside money for tomorrow or for another day is really important. And this is the reason. The reason you have to pay yourself first is because, like we've said, the crisis, the challenges that are coming, there are cracks that are forming below us, and we may not be able to see them. Today may look so fine because the paycheck is coming on time, Absa is paying me on time, or my hustle is doing very well, but there are cracks that come underneath, and sometimes we don't see them, but we've got to be ready for those types of situations, and you'll only respond with money. A lot of things can be tackled if you've got the wealth. So if you get your wealth, your money today, your income today, then saving and investing should be automatic. You should pay yourself first, because you do not know when this stream of income that has been coming to you will be cut off, and then you're exposed and the ground becomes all broken and everything is crumbling. COVID taught us way too well, and many other crises that have come. And what we can say is that crises will come. That is not if they will come. They will come. And I'm not being a prophet, because they will come, and it is becoming more apparent that crises will come faster and more, they're faster and quicker than they were previously. So being ready and making sure that we've got our act together, our money together, is very important. So I'll say pay yourself first so that you can prepare for the next thing. And how you do it, you automate. At Absa, and I'll just use Absa because we are Absa, right? At Absa, you've got a way of putting your money through your CASA, and then you can take it straight to a savings account or to an MMF. Make sure that you're saving at least 20% of your income if possible. But you won't be able to see those savings if you haven't already audited how you spend. A lot of us, and I've seen one of the question people saying, I don't have enough income. That's always how we are tuned, because the spending is almost automatic. Nobody teaches you how to spend. In fact, every child knows, if I get money, I'll buy a sweet. If I get money, I'll buy X. But nobody really teaches us how to save and invest. So you find your spend power is already there. It's a natural disposition that we all have. So you've got to then audit and say, how am I spending money, so that you identify where the leakage is if you don't have any savings today, and therefore you start saving. And I usually say even the person who is earning little has the ability to save if only they audit how they spend. Reason being, research has showed us that at least 30% of your income, you cannot account for it. And I'm not saying 30% of the income from wealthy people, 30%, even the ones who are earning at the bottom of the pyramid, they cannot account for 30% of the incomes they make, meaning that there is an ability to cut back on those incomes that are leaking. Let's call them that. Let's say they're leaking. You're leaking, but you do not know that you're actually leaking out money. So once you do that, automate, put your money straight to your savings Zidisha from your CASA account to your Zidisha or to an MMF. That's possible, and it is free. From there, once you have done that, what you have just achieved is, first of all, to postpone instant gratification for expenses that are always coming. So you have now the ability to say, my money is already separated from myself. I can make then conscious decision around the next investment, whether it is a long-term investment, medium-term investment, a retirement investment, or even an education policy. You'll be able to make that decision really, really well. And when you move to investing, I know most Kenyans have stayed on the lowest risk type of investments. So we like things that are preserving our capital, which is fantastic. And it's a nice way of starting, but it is not a destination. So your money market fund, like I saw most of you saying, we have invested or have invested in money market fund. That's not a destination. A money market fund is supposed to be like a parking bay before you can translate this money to another investment vehicle, which is earning you more return by taking some extra risk. And risk here means that you need to view your investment in the lenses that investment go up and down. And so you need to assess which kind of risk, movement up and down of prices can I be able to take so that I earn a higher return as I invest longer, because money market funds only work for the short term, and we do not want to tell you that once you have got a money market fund, you are in the you're going to make it, or you're going to build your wealth astronomically. That can't happen, because that is interest earning, and interest is capped. But when you move to assets that are earning higher interest, like government bonds, or you move to equities, equities give you capital gains. So capital gains are the ones which can be exponential, but money market funds don't have exponential growth. So wealth building is about exponential growth. I don't know whether yesterday any of you watched what Trump has done in the first year of his presidency and how much money he has made. There's nowhere he has invested in a money market fund. He talked about crypto. He talked about some other unique assets like watches. Of course, him is in the ultra wealthy people, but tells you wealth building is not for being too conservative. So remaining too conservative denies you the ability to grow your wealth. And as I continue, I want to show you an example. For example, last year 2025, money market funds were still doing well, 9%, 10%, and you sound like you're doing really well. But on the other side, our stock market was also blazing, really, really nice. And equity fund was making 40%, but it meant you've got to understand that if you came to an Absa equity fund, there is the chance that the equity prices can come down, but also the chances of going up are really high. But we saw those people who split maybe their 1,000 between money market fund, a percentage in money market fund, a percentage in equity fund, the aggregate return was actually higher because of taking a little more risk. But sometimes we stay on the very fence and protect ourselves too much, and we leave money on the table. So don't leave money on the table. Start experimenting with a little higher risk type of products, and only leave maybe money market fund for your emergency fund and not as your ultimate investment. The third thing you'll do is debt management. I know we give debt, but we want you to take debt with a very clear mindset that you do not become debt trapped and therefore take out whatever other investments you have done. So manage your debt well. Make sure that you're not taking expensive debt. Again, audit your debt. You should be able to know what is the most expensive debt that I'm paying. And I will surprise you and tell you that banks will have the cheapest debt ever. Banks have the cheapest debt. I know we'll have mobile debt, but mobile debt will always be your most expensive and aggressive type of debt. So be very careful. Go and audit yourself, see where it is, and how do you deal with debt if you find that now you're in a debt trap and maybe you have very expensive debt. You've got to have a strategy to clear the most expensive debt or consolidate and use maybe a bank debt. Don't be afraid of taking bank debt because many people tell us, the bank will auction me if I take debt. And they are so afraid. But there is quality debt and there is poor debt. Don't take consumer debt because consumer debt does not bring in any income. You need to take quality debt. And so there's good debt and bad debt. Once you audit that, whatever is a bad debt, which was a consumption debt, please start removing it out of your way. And once you address that, then you'll find you have money, even more money for investing. And finally, asset protection, which is what Julia will talk to you about. You have acquired these assets, they're sitting pretty, maybe it is a property, maybe it is even your own health is actually an asset. How are you protecting that? Because you need to protect that. But Julia will talk about that. That's part of becoming, building a proper journey towards steady wealth for yourself. And finally, you cannot stop planning. Financial literacy is really important. What you've done today is a big investment for yourself. Continue learning because in the investment world, things are moving. 5 years ago, we were not talking about digital assets. Today, they are digital assets. So if you just stay with the knowledge you got in campus, you're still in the days of buying plots. So you're still chasing plots and all that. I'm sorry, there are new assets that have come. The exchange has new, kids who have been listed. Have you taken advantage of that? So financial literacy is really, really important, and you've got to engage and take in as much as possible whenever you get professionals giving you this information. So back to you, Sima. Those would be my nuggets for somebody who is looking into, securing their wealth.
Fantastic.
Yeah.
That was a lot of information, Liz, in response. I think you've answered all of my questions in advance, but I just want to pick up on some of the things that you said. So the first thing is just look at your budgets and make sure that there is something available for you to pay yourself with. So paying yourself is one of the things that I got out of that. Sure. The other thing that I got is that at least 20% of your income should be saved. Yes. Yeah. So that's the second thing I got. The other thing that I was really surprised by is that 30% of our funds go into unaccounted expenses. Yep. And that's a huge amount. Imagine if we actually did account for our expenses and put that 30% towards building our future. Mm-hmm. And so it's really around ensuring that you go through your budgeting and are careful about how it is that you manage money to create that room to spend, to save. And then ultimately ensure that we then do save it for our future. And so I wanted to ask another follow-on question. Yes. Based off one of the things that I said earlier is that women do outlive men. Yes. So they will be around for 5 to 7 years, on average, longer than their partners. Yeah. And so based off of that unique aspect, is there anything that you would like to tell our ladies around how it is that they should invest differently, considering that they are going to live a little longer? What are the nuances in that financial journey that they need to do? What are the investment strategies that will keep it there for a little longer?
I'll tell you that investments are similar for all of us. But if you know that you're living longer, we call it longevity risk. That is what women will face, longevity risk. So what that means is that you need to spend whatever you save then very carefully because you're going to live long. If you're my grandmother who went all the way to 120, that was long. Wow. You could live longer than you worked. Imagine, you live longer than you worked. So it means your working life, you need to be more diligent because it could mean that you said you're 28 years working, I'm 25 years working, whatever years. You can imagine when we retire, maybe we have worked 30 years and we're feeling like, hey, we've really, really worked. But then you go on and live to 100.
Right.
It's 40 years. You've got to finance the 40 years. So it means your working life and when you have strength, has to be very intentional. You've got to be intentional. I know in the African space, we like ignoring the future and we think, my children will take care of us. Can tell you Gen Zs, when we question them, they are so clear. You'll take care of yourself, mom. You'll take care of yourself, Julia. Okay? So do not look at those girls. They're so clear in their mind. So we've got to be intentional today about our saving culture and not being too conservative in our savings. Take the example I gave you. Money market fund giving you 9%, equity fund giving you 40% last year, and let's say now we're in 2026, money market fund giving you 7.5%, and equity fund, let's take it like this year was a bad year. It gives you -5. I want to show the volatility. Today it's positive. I just want to give you an example which is negative so that you can see why how you can be able to ride out. So if I combine 2025 and 2026 for money market fund, I'll have got 10 plus 7.5, 17.5, thumbs up, really happy, no negative, right? Then the guy who went to equity fund, let's say it's Julia. No, she's very brilliant. So Julia goes to equity fund, she buys and she got 40%. Then this year, oh God, things are not really nice. I think there are elections coming. Equity fund maybe does 7% negative. So combine 2025 and 2026, she's making 30, maybe 33%. She's still ahead of you. Now let's play that 20 years in our life. I can tell you when I'm retiring with my money market fund and she's retiring, she will be going for holidays and I'm stuck here. Because she took some risk. I'll be stuck here. But we'll both be saying, I invested, she invested. She took more risk. She had the ability to ride through those cycles and ride higher. That's the beauty of investing for the long term and not always asking, what's the rate today? What's the rate today? Did it go down? I think that is where we need, as women, we know we are more anxious people than we don't have that resilience. I'd ask that we build our muscle by testing. You don't put everything, because I know also emotional heartbreaks in the investment world really hurt. They hurt and they last for long. So what you do is, if you have a million shillings, invest maybe 60% in money market because you are that anxious type of person, and then 40% can take risk. But don't always go for the most secure, sure bets. You know, sometimes even women are caught out because they are told these are sure bets. So they follow everybody else. By the way, in investment, there are no sure bets, unfortunately. There are no. So there has to be those ups and downs, but you've got to work with the right partner. Did I answer you? You
did. You did answer me very well. And I wanted to again ask, because actually risk and the fear came up as that. So yes, you've addressed that, because I think a lot of women don't have that confidence in terms of investing, because first of all, there are so many options available. And what you've spoken about are obviously traditional bank savings. You've spoken about money market funds that come with a little less risk. Then you've spoken about higher risk ones, which are equity type investments. For the long term, you know, you have things like bonds and you know, offshore as well. So there are different options. And what confuses a lot of us is how much do we put in different things. So what you've advised also is 60% to kind of balance your risk out in safer assets, right? Is that what you had confirmed?
Yes, you've got to balance. You can't have everything, because in the investment world, the area of investments are many. There are very many. But you've got to have a diversified portfolio. Make sure that you're not investing in one style. Case in point, we have the generation behind us, or the older guys. They're ahead of us or behind us. Those ones. We know them. Those ones. They bought land, and they bought land and land and land and did nothing else. For every shilling they earned, I think they were putting most of it in land. Now they are 80, 70, so most of them, they are asset rich, cash poor, because they didn't diversify. Did they do well in investing? Yes, I will tick them. They did well in investing. What went wrong? They just did not think about their old age when they won't be working and they need cash flow. So at every stage, you've got to think, how well diversified am I in my portfolio? So don't be looking at your portfolio in isolation or in buckets. Look at it holistically, draw a pie and ask yourself, out of my 1 million or 3 million or 10 million, 100 million, how much is in property? You'll catch yourself. If you're just in property, you're in a good asset, but illiquid. If you're only in money market, you're too conservative, because then you're saying, me, I'm expecting the world to end tomorrow. It's like that's what you're saying to me, even as your manager. If you're only in the stocks, then you're saying, I'm chasing every form of return. And you could have a crisis, and then that is the period the stock market is down, and therefore you'll get emotional damage because you'll be selling your stocks at fire sale prices, which is not good. So a balanced portfolio helps you to address all segments. You have fixed income, you have offshore. Offshore is nice because you're getting now to a different currency, but if the currency goes a different direction, you could also suffer. I'll give you an example of Zambia. So Zambia, and I'm sorry to take you to Zambia because it's a very interesting scenario. If you're in Zambia maybe 5 years, the last 3 years, Zambia suffered a lot and their currency depreciated heavily. So most people preferred offshore investments because they were saying, we need to run away from kwacha. Even in Kenya, we did that in 2024, Sima, your customers especially. Let me run away from Kenya shilling, and I moved to, because it is depreciating. In Zambia, it was let's run away from kwacha, we need dollars. So they bought quite a bit of dollars. Play 2020, 2026. The currency back maybe 2023, it was trading to the dollar at about 40 kwacha to the dollar. Today, it's trading at 18. So the offshore investor is losing. Imagine if you have only offshore, what that means, your portfolio has shrunk. The only beautiful thing you have is, I have dollars, not kwacha. But you're living in Zambia, you need to spend in kwacha. So you must bring maybe part of it to pay school fees. So you'll be converting now at 19, well, because you went in when it was at 40s. So that's the kind of risk. So if you have a balanced one, you can say, wait out. I still have some Kenya shilling, some dollars, some fixed income, some equities, and you'll be able to balance out even how you spend. So that's the kind of balancing you need, diversification.
Okay. Fantastic. And diversification, I think, is the word. It's really just important to make sure, first of all, that you speak to an expert. You speak to somebody who actually has all the information, sits with you, understands your financial situations and what are your priorities in the near future and in the long term, and helps you structure a set of investments, as Elizabeth has spoken to, helps you diversify your risk and empower you to take the next step. And what I think is beautiful is that a lot of people, a lot of women feel that investments are out of their reach. I believe the entry into the money market fund is 1,000 shillings.
Yes.
And so that's all you need to take your first step to actually start investing in a portfolio. I would like to now just move over to Julia, because I know that wealth management also stems into insurance. There are certain insurance products that will also create that investment opportunity, especially for longer term assets as well. So if you could just answer two things. The first thing is, why should an insurance plan be a priority? That's number one, when it comes to wealth management. And number two, what are the insurance options for wealth management as well, or for meeting future needs from an insurance point of view?
Thank you, Sima, and thank you, audiences, for joining in. And I've seen a lot of questions and engagements on the net. Gashoki, I've seen their questions. Dr. Elsie, I've seen you, Fanny's, and the rest of you. Thank you so much for the engagement. We want to interact and learn a lot more today. So from an insurance perspective, and let me start by saying, as women, we must always remember, because I believe I'm talking to a lot of women who are seated here, we kind of become the centerpiece or the anchor of many things in our lives. Whether you're single, whether you're married, whether you're divorced, whether you're widowed, whichever space you're playing at today, remember that you're the centerpiece of your life. So as you're living every day, you're building wealth, you're doing very many things for your life, you're thinking about tomorrow, you're thinking about family, you've got children sometimes, you've got dependents, you know, you've got aging parents, you've got very many things around you that you have to navigate, a lot of moving parts. We've got to remember in all this as we are progressing in our lives, there's always an element of what if. There'll be always what if. If something happens, then what happens to us? And this is something that I keep telling people, that you're working very hard to build your wealth. You're waking up every day to do things, but we cannot ignore that as we move through life, there are always risks that come with that. And the risks that affect us directly, whether it's your health, you know, because we can easily fall ill, whether there are accidents that happen to us, you know, and just building, you know, when I'm building, for example, I'm building my funds here, I have estates and I have assets. I've got to work to protect what I am building. And why it's important to protect as you're building is, if you, for example, fall ill and you're admitted in hospital and you do not have an insurance policy that pays for it, you'd have to go to your savings or maybe sell your property or whatever it is to pay up for that. When your children are growing up, you've got to put some insurance aside for education. And I'll give my personal example. I lost my husband in November. School fees had to be paid in January. He was the one who was paying the school fees. What paid for that fees was about 2 million shillings for the two of them was insurance. Because you cannot access anything. Maybe the lawyer will give us more on that. You can't access anything immediately, whether it's money in his account, whether it's there's property to sell, you can't do it. There's a whole process of administering. It's very lengthy, by the way. So when I sit here, insurance was the only one that paid within 10 days. You get the money. So I'm asking people, when you are sitting here, you've started your life journeys, you're born as a child, you're going into teenagehood, you start working, start taking life insurance at that point. Something that in case I'm not there, this money can do this and this and that. Remember, you can even be a charitable person. You can even sign out the money to charity, you know, because you want some of the courses that you are running to continue. You buy an asset, you buy a car. When you're buying a car, you've got to have insurance on it because it could get an accident, something could go, the engine would knock, or something would happen to it. And anytime you get an accident or something happens to you, you find that you've got to spend money to fix it. What if you had insurance? It can be as simple as your phone that you carry every day to work and it falls and cracks. Or your iPad, you know, those very simple things that we take for granted. You can say, I'll get another phone. But look here. If I am buying my phone for 20,000, 100,000, 200,000, or maybe an iPad, and it cracks and I need a new one, then I'd have to go to my bank account, get the money and pay. That money would have been put in maybe in money markets or something else, and you continue building your funds. But now you are going to buy a new phone. But had you taken insurance on it, then you just go and claim and get it back. So you've actually conserved your wealth. You've protected it. When you're having homes, you're building homes, I encourage couples to have joint life insurance, you know. So one spouse goes and maybe you have a huge mortgage, you know, that you're running, whatever mortgage you're running. Remember, when one spouse goes, if maybe they were the ones who are running it and there was no life insurance, then the burden is left to the surviving person. So what happens? Then you've exposed the family to a whole lot of, you know, money that needs to be sorted, and very many other liabilities, loans and everything. So come together as couples and always have life insurance. As a wife, as a husband, as a family, have life insurance. Because what happens is whatever you're trying to build, insurance comes in to cushion, to protect it and make sure that it's sustainable, it continues. And I like that Elizabeth says you want to go on holiday. Thank you for wishing me well, because that's what I want. So when I get to I don't want to go to holidays and I'm 100 and I want to drive my, you know, like when I'm 60, 65, I want to drive my Bentley. I still want to drive it. So I have to make sure I'm taking care of my health today. And it can't be cash, because then I can't invest it. I've got to say I have insurance here. Even when your parents are not well and you've taken insurance for them, you don't have to send them money. They have insurance cards. They're just going to hospital and they're getting sorted. Otherwise, you'd have to send money, M-Pesa, or whichever way you have to send money. When your kids are falling ill also, you've got to spend money. But if you have insurance, then They just swipe the cards and they get treated. When your kids are growing up and you started, let's say, you can say, at what point do I start? I saw a question like that. When I have, as soon as you get a baby, just start. And you don't have to have 1 billion shillings or 1 million shillings. You can be having 20,000, put 1,000 bob, 2,000 bob. And there's something around longevity. So as you grow, you can keep increasing, you're keeping increasing. So if you started when your child was 1 year old and then they're going to maybe mid-school at age, is it 15? Is when they go to high school, 15 years old. You've saved for 15 years. And you can take that out, that money, and pay for fees. And remember, for education policies, how they work. Should a parent be diseased, for example, like the case of my husband, a part of it is paid immediately, and the rest continues. The policy runs. What they do, they waive the premiums, and the insurance company starts paying for you for the dead. You get? Up to the point where you wanted the money to pay, because this money was supposed to pay for university. So at university in the next maybe 4 or 5 years, I'll still go and get that money, and it will pay for their university. So I don't have a headache around that. So those are some of the things that I really like to encourage people today. Think, as you're building your wealth, as you're building your businesses, by the way, and there's also business, you find you're maybe a sole proprietor or in a partnership or in a corporate, you are the key man. You're running this business, something happens to you, your skills and knowledge are not available, they're not there. They've got to hire, they've got to spend money to hire these skills. Or your shares do exist in this company. But you take a Keyman insurance to match up either the shares that you have in the company or even a replacement of you, so that when you're gone, the business doesn't think of going to withdraw money to either hire somebody or these shares, how can we dispose them? But the insurance will come and say maybe they had 10,000 shares, 100,000 shares. The insurance will come and pay that money to the business, maybe to continue with the skill or to inject more capital or to buy out the shares so the family can take out the money. So there's a lot of things that you can do with insurance to actually conserve your wealth. When you're running a corporation as well, they have got assets that you're buying, you're running your business. Thugs can run into your store and take away everything. And then you have to come to the bank and borrow. But if you have insurance, we'll just come and restock it for you, and then your business flourishes. I was handling a case of a lady who had a kibanda. Was it in, I don't know, Gikomba or this market, toy market. So it got burnt. And this lady was so joyous because she'd taken insurance. And she said, everything they burnt and everything burnt. And in 48 hours, she had gotten 200,000 because she had taken insurance, 200,000. And she restocked, and her kids went to school. So you see, it's as simple as 200,000, but she did not have to worry, because if it's burnt to zero. You've got to start building from zero. So what we are saying is, as you're journeying through life, as you're working very hard to build, remember, you've got to protect what you're working very, very hard to build. And by protecting it, you're saying you're conserving the wealth today and tomorrow, and even for the people that are depending on you and for the generations to come. So that's where I can bank it.
Yeah, thanks. Yeah. Thanks, Julia. Just out of curiosity, I just wanted to know, the lady who had her stall burnt in Gikomba, how much did she actually spend towards her premium?
Oh, she was paying us a premium of about 30,000. 30,000. She had paid us a premium of 30,000, so 3,000 per month to cover for the whole. And
so that just shows you the power of just a small premium and what it can do for you in times of need. And this stat that we shared earlier, the 2.4%, is something that, for me, insurance seems to be a no-brainer, but yet we are seeing penetration at 2.4% in Kenya. What are some of the things that we can kind of demystify to kind of empower women to be taking up insurance products? Maybe you could just bring that angle into it. What are some of the insurances that women themselves really must prioritize as they go through their journey?
So thank you, Seema, for that. And I can see another question. You've just emphasized on the importance of spouses taking out joint insurance cover as part of prudent financial planning. Building on that, I'd like to ask about estate. Okay, fine, that's estate planning. So, so for us women, firstly, we've got to prioritize health. Health insurance is it's a must. because I see a lot of, because we handle even medical insurance, and I see things to do with either fibroids, reproductive health. There's a lot of that, and a lot of money goes there. Menopause, premenopause, there's hormonal therapy. It takes money, by the way. There's also beauty. I mean, you see a dermatologist, sometimes. See, there are many things, dentists, you got cavities, and that takes money out of you. First of all, prioritize health for you and your dependents, because health can take away everything. And if you're not healthy, then you cannot wake up to work. So you must keep healthy. Eat healthy, exercise healthy, take out insurance, live healthy. Health is number one. Once you prioritize that, everything, now you're active, now you can do things, now you can wake up and run, Then now remember, there's school, because we've got to go to school, you've got to learn, whether it's you, whether it's your children. You can even take out your own insurance and say in the next 4 or 5 years, I want to go and do a course and have an Ivy school or wherever. Put it aside, take out insurance on it. If you survive, you get out the cash and pay, and pay for it. For your children, you have put money aside for their education. Remember, you are their anchor, you are their centerpiece. And if it's your spouse, also ask your spouse to take it. If you are two of you, they take out insurance for the education of your children, because then they need to have skills, they need to build knowledge, they need to build financial know-how and many things about life. They need to learn. So it's important for you to take your kids to education. So that's also a very key priority for women. Because then if you empower them, they are able to navigate and handle a lot of things. And when you're not there, they'll continue learning, because the money that you're saving will protect them. And thirdly, but not the last, is your business and where you stay. You've got a home, you've got a business you're running. That's what keeps you. Every day you go home to spend. So your home insurance is important. If something happens to this house, where do we go? So you've got to take out that, and the business that you're running, if you're in business, or if you have a loan or whatever it is, you've got to have insurance, because then that is about sustaining your lives. Because then the business if the key money is not there, what happens? If the jobs you're doing today are not there, then what happens? So you can actually take out, they call them the things like even retrenchment covers. Like maybe you both are working and somebody's retrenched and they didn't have a retrenchment insurance. So they survive without an income. But if you're taking a retrenchment cover, it can pay up to maybe 6-7 months of the salary you're earning. So those are some of the key priorities that I think as women we need to have before anything.
Yeah, fantastic.
Yeah.
Health, education, shelter, and
business,
and income
Yeah.
generally,
Yeah.
just protecting the income. And I think that's great. Just as an example, I actually signed up for a education policy when I had my baby in my belly, and I've not paid their high school fee, their fees up to high school. It's been paid by the education policy. And so the power of insurance is exactly that, is being able to identify a potential need in future and start saving towards that. So let me move on to Gladys, because I think also there are quite a few questions here, and a lot of women are concerned about what happens in the event of something happening with my partner, etc. How will I sustain my livelihood? And that ties into all three, in terms of investment, insurance. But what I would like to ask is, when you build wealth, what are the non-negotiables that women should have in their estate plan? First of all, why is it important to have an estate plan? Let's just start there. Why is it important to have an estate plan? And what should be included within the estate plan, regardless of how old you are or how much wealth that you have?
Thank you, Seema. I think a lot of times when we use the word estate plan, people start thinking about, big estates, like Langata estates. And so they say, I don't have anything, I don't have that kind of estate. But estate really is what you have. Regardless of the size of it, an estate is what you have. And an estate plan is what you're going to do with what you have. Who are you going to give it to? What do you want to do? How do you want to use what you have? So an estate plan is not about being wealthy. A lot of people say, I'll wait until, in fact, somebody told me the other day, oh no, I'm only 30 now, I'll do it later, when I'm 60 or so. And of course I told her, who promised you tomorrow? Who promised you tomorrow? Nobody promised you that. So it is important from the time you're 18 years old to start thinking about an estate plan. Why? Because you have something. You have a bank account at the very minimum. Many people have M-Pesa. You already start from there. So an estate plan is about deciding, what am I going to do about what I have? And some of the non-negotiables that you should have, and we always encourage this, is that at the very, very minimum is you should have a will. And the reason why you should have a will is that it helps you decide, these things that I have, who am I giving them to? I have children, I have spouse. I want to ensure that they get what I have planned for them. Because, of course, if you don't do that, if you don't have a will, remember this, many people will say, and I saw even in the polls, some people saying, I don't have an estate plan. And my answer to that is, actually, you do have an estate plan. It's just that now it's the government that will decide for you how your things are going to be distributed. So why don't you take the responsibility and the initiative to do it yourself? It gives you the opportunity to choose your executors, the administrators, the people who are going to run your estate. It gives you the opportunity, if you have small children, it gives you the opportunity to choose the guardians that you'd want for your children in the event that you're not there. So that you're not leaving the government to choose a step-brother or sister who will actually torture your children. You know the people that you trust. It might not even be your siblings. It might be your friend who you'd want to leave as a guardian to your children. It leaves you to choose the trustees that you trust, because like if you have young children, for example, you must have a trust. And if you have young children, who is the person who is going to hold those properties for the children? Because remember, a child can't hold property for themselves until the age of the majority, which is 18. So in the meantime, who holds that property? You would rather have somebody that you trust, whether it's a mother, a father, a best friend, somebody that you trust who will be able to look after that property. And so a will lists down all these things. And let me tell you something. The courts will go in accordance to your will, provided that you have done a properly prepared valid will. Okay? Many times, it's true that many of the issues that we have with wills are maybe to do with men sometimes, because sometimes they have an extra family that they have not mentioned in the will. And so, of course, that extra family will come and say, we have not been provided for. Usually women will know the dependents that they have and they'll include them in the will. And so when we're talking about wills, we're saying you are organizing yourself, you're sitting down, you're looking at your assets and ensuring that everything that you own is put inside the will. Many times women forget, and not just women, actually everybody forgets the kind of things they own. Whenever we sit down to do a will with people, we're like, what are your assets? And they'll say, oh, I don't have anything. I say, do you have anything on the stock exchange? Oh, yeah, I've got shares in the stock exchange. Oh, yes, I have a chama and I have shares there. Oh, yes, I bought a property in Kitengela. I completely forgot about it. And so it's important for you, even as a woman, to sit down and do a list, an inventory list of what are the things that I have. Because your assets are not just real estate property. You've got accounts, you've got money markets, you've got insurance. Yeah? It's important to sit down and list all these things. And sometimes, one of the reasons why we say this is because your family may not even know what you have. It's only you who knows it. It's your own little secret. Ensure that you prepare at the very minimum a will. If you have a lot of property, or if there's certain properties that you want to protect to ensure that they don't get sold, like ancestral land and things like that, you can say, I want to have a trust. I want to ensure that this property stays in the family for generations to come. You may want to have a trust so that you can build generational wealth for your children, your children's children. And so a trust is another thing that you can consider. You can look at even things right now when you're alive, things like power of attorneys. I may be traveling, I may want to give somebody a power of attorney so that things can continue while I'm away. Or I may want to have what we call an enduring power of attorney. In the event that I get sick, who am I giving this power to make medical decisions for me, for example. And of course, as they have all spoken, it is important to have life insurance. People will say, I don't have any money. But let me tell you something, life insurance is not expensive. It's actually cheap. And so at the very minimum, for your loved ones, and especially if you have young children, have life insurance. Because as Julia has said, the moment something happens to you, that life insurance is paid out. It doesn't even have to go through the process of a will. It doesn't have to go through what we call the probate process, going to court. It is immediately paid out to the beneficiaries who have been named in that policy. So I think some of the things that I'm saying, non-negotiable, have a will, think about a trust, have life insurance. For me, those are the non-negotiables.
Okay, fantastic, Gladys. What I'd like to come back to is something that you said earlier, and I think you've spoken about this so many times, and it's always intrigued me, where you have your husband who has an alternative family, and there are relationships that are unknown to you, and I'm sure a lot of women who have dialed in are in complex situations. Could you just talk us through some of those realities? What do women need to look out for to ensure that they and their family are protected where such situations could arise?
Exactly. And in fact, one of the other things I was saying to your staff the other day is also, number one, get your husband, don't just do a will yourself, get your husbands to actually also come and do a will. And usually we'll ask the men to tell us if they have any other families, because it's important for them to actually include them inside their will, so that later on they don't come out and start complaining about that. But as a woman, if my husband decides he's not telling me that he has another family, put your things in a trust where somebody else cannot come in and start claiming on it. And there's a way we can couch that trust so that it protects you and your unit of family for now. And somebody else cannot come out from the woodwork and say, oh, this was my dad. Well, the trust doesn't belong to him. It belongs to the family trust. So they can't come in and claim that. So it's important, even as a family, to have communication about how do we protect ourselves as a family. Get your husbands to talk to do it. And actually, one of the other reasons that I tell women to speak to their husbands is that in the event that their husband, and maybe many times in the Kenya that we live in, they're the ones who have maybe more assets, etc. If something happens to him and he doesn't write a will, and the law takes over, one of the things that happens to a woman is that you get household effects and some little money. But everything else, you hold it as a life interest. So you are not, so your husband, you have built these homes, you have grown together, you have built this whole empire. Guess what? If he dies, and maybe the properties are all in his name, if he dies without a will, you only hold a life interest. And what that means is that you can't just start selling off properties, because you're holding it for the benefit of your children. And your children can stop you from selling anything. Your children can decide, Mom, you're wasting our inheritance, and they can take you to court, and you'd have to account to the court. Why would you be put in a position lower than your children? Insist on your husbands having a will and leaving some of those things to you, because you don't want to have a life interest. Recently, we saw some cases of a politician, of a very prominent politician who died some time back. And the wife was very ill, and she wanted to sell one of the properties. And the children took her to court and said, no, that's for us. You're meddling with our inheritance. They were not there when you're building this wealth with your family, and with your husband. And so it's important to ensure that even your husbands have an estate plan, because you don't want to end up with just having what we call a life interest. You can't sell. You can't sell the property. You can live in the property. You can eat from the proceeds of the property. But if you want to sell, you'll have to go to court, and you have to have a very good reason for doing so. And so, so those are some of the reasons why we insist on ensuring that people have estate plans.
Yeah, thanks, Gladys. I think this has sparked quite a bit of attention in terms of the questions. If you can just scroll up, there's a question that Jemima has asked that I'd just like you to respond to. So Jemima, thank you so much for the question. And what she says is it more appropriate for each spouse to have an individual will there is still a common perception that the responsibility for writing a will primarily rests with the husband. From a wealth management and succession planning perspective, what would you consider best practice for married couples? I know you touched on it slightly, but could you just expound on that a little?
I think number one, like I said at the very beginning, each of us has something, whether it's an account, whether it's a plot that I bought somewhere, whether it's a piece of jewelry that I have. Each of us has a property that we don't even own individually, we don't even own jointly with our husbands, for example. But, and so for each of us, we have to take responsibility for having a will. You can't wait for your husband alone to have a will. You too must have one. And yes, you can. We have what we call joint wills, where you can have a will together. We don't encourage joint wills because the moment one of you passes away, the whole will becomes public, because then it has to go to court. But what we encourage is you can have what we call mirror wills. So you have wills that replicate one another because maybe you own property together. And in fact, on that note, in fact, one of the other things I think I should have mentioned was joint properties. A lot of married couples have joint properties, and when you have joint properties and it's registered as joint properties, it means that when one of you passes away, and it's another form of estate planning, is it immediately goes to the survivor. The rule of survivorship applies. And so if you have a joint property jointly owned between you and your husband, when one of you passes away, it goes to the other person. And the same way with bank accounts. If you have a joint bank account with a survivorship clause, so that either or can sign, when one of you passes away, the other can continue using that account. So it's important to ensure that you look at how you hold properties. Is it jointly owned? Is it only in your name? And if it's only in your name, make sure, again, that it goes into the will and you discuss how that is going to be distributed.
Okay.
I think.
Thanks.
Yeah.
Yeah, so leveraging on that question again, and Julia touched on the fact that insurance doesn't have to go through the probate process. Properties, even though you have it as a joint property, or whether you have the accounts as a joint account, does that still have to go through a probate process? So what actually bypasses it? Is it only insurance that bypasses the probate process?
No, joint properties, jointly owned, and I keep on using the word jointly, and the reason I keep on using the word jointly is because many title deeds will have, let's say, the name of Mr. and Mrs. Kamau, but doesn't have the word jointly. So it says this property is, owned by Mr. and Mrs. Kamau, but it misses that word jointly. And if it misses that word jointly, it might be presumed that each of you own it 50-50, okay? If it has the word jointly, then it means it's undivided. It's owned by both of you, and that particular one, that jointly, does not go through probate. Okay. All you need to do is get a death certificate and give it to the land registrar, and then they will change it from, let's say, both your names to your name alone. Okay, so the important thing is that jointly word in land, in property, and I think in accounts, in bank accounts, I think you have something that says survivorship.
And
yes,
survivorship
exactly. And so that doesn't have to go through probate.
Okay, thanks.
Yeah.
There is also more interest on trusts. I think a few ladies have asked around trusts. So the first thing is, could you describe to us the difference between a will and a trust? And who can make a trust? How do you register it? And what are the benefits of the trust? You did mention that when there are funds or etc. Assets in a trust, that it is protected. So could you just explain why and what's the difference between a will and a trust?
Okay, a will, like I've said, well, maybe I didn't say, but a will is just, it's a document that declares what you own and how it's going to be distributed to your dependents and to others, okay? A trust is can I put it like, it's a different entity. It's not owned by you. So for example, if I create a trust, me as Gladys, I can call it the Gladys Family Trust, okay? Which means I no longer own it. So it's like a company in a way, the way companies have a separate identity, a trust has a separate identity. So if I have a trust, it will be owned by the Gladys Trust, okay? And I, Gladys, can be I'm the founder of that trust, and I can also be the first trustee of that trust, so that I also manage the properties that I have transferred into the trust. So if I have assets like shares in a company, if I have real estate, I can transfer that real estate into the trust, and it will be held by the trust. So that property is no longer mine, it's actually held by the trust. And so somebody can't come and say, oh, Gladys, you owe me money, I'm going for that property. They can't go for that property because the property no longer belongs to me, it belongs to the trust. Okay? And so trusts are registered in two different ways in this country. We either register them under in the lands office, or if you want to incorporate the trust, we register them under the BRS. Now, the difference between a trust and a will is that a will is about the properties that you own, okay? A trust has moved the properties that you own into the trust, and it has that layer of protection. So a lot of people will go for trusts when they have, let's say, like I've said, young children, because a child will not be able to own a trust, a property. So you have to hand over that property to trustees to hold that property in, for the child. Do I have to create a trust at this stage? No, I can create a trust even inside a will. I can create a trust inside a will. I'll say, I want this property in Athi River to go to my 5-year-old child when they turn 18. And so Mary, my very good friend, is the one who will hold that property until my child turns 18. And Mary now becomes a trustee and has a very, very important role and a duty of care, very high duty of care, to ensure that what you have mentioned in your will is going to be done. And if it's in the trust, the difference is that a trust is more private. People don't have to see what's going on inside there. A will becomes a public document the moment you pass away because it has to go through probate. A will is quicker, it's easier to make. A trust, you have to sit down and think about what is the reason for having the trust. Do I want to protect my property? Do I want do I want it for generational wealth? Do I want it to go on into perpetuity? What is the reason that I'm actually preparing what we call a living trust? Okay, and the beauty, of course, of a living trust is that you kind of manage it while you're alive, as opposed to a will, which only takes effect upon your death. I hope I haven't confused you.
And I think, Gladys, thank you for that. I just wanted to reemphasize there's a lot of questions around what is the cost of this and how do we get access to this. We, as Absa, have partnered up with Gladys's team to offer wills and trusts and the entire estate planning process. And I think one of the offers that we have going on today is that if you do reach out to the team, and we'll share the contacts at the end of the session, is that you will get a discounted offer from an already discounted package that we have as a result of the relationship with Absa. So I do encourage you to take contacts at the end of the session so that you can have those detailed conversations pertaining to your individual situation and what it is that you want to protect around. And in terms of timelines, you can be 18 when you start the process. Absolutely. There is absolutely no restrictions. There's no myths about you have to have acquired assets, you have to have acquired wealth. You can start at any point in time. So no, thank you so much, Gladys, for that conversation. There are some additional questions, and please do keep them coming. I do want to take the opportunity to come back to the other speakers with some of the questions that have been asked, and possibly starting off with you, Elizabeth. There is a question that has been asked by Teresa. Teresa is asking, how can one manage between overwhelming loan repayments and investment?
Okay, so debt and investment. Yeah. So if I hear the word overwhelming loan repayment, it tells me that the debt is choking somewhat. So you need a strategy. You need a strategy to deflate that loan first, because loans are contracts that you've already entered into, and those obligations must be honored. So we need to look at your loan and see why is it overwhelming. Maybe it is the type of loan that you have that is just wrong for you. Case in point, maybe you're overwhelmed because the loan is from maybe a microfinance, which are very expensive, and you can be able to sell out that loan to another lender who takes it at a cheaper price, say a bank. So if you had a loan with a microfinance which is charging you, say, 20, 25% or whatever amount, you can negotiate with a bank and say, buy out my loan, this is my income, buy out my loan from my MFI, and therefore deflate the cost of paying back. Or you can negotiate with your lender and say, my loan is choking. I would like maybe to extend it from maybe being a 3-year loan, maybe provide an asset, and you get an extension of the repayment. So the repayment period becomes longer, and that deflates the repayment amounts that you're doing. So there's a strategy you need to have. So sit with a banker, let's see this holistically and see what is the solution to bringing down that choking loan that you have. Once you do that, whatever savings, or maybe even it is consolidation, there are loans from different places. You can do a consolidation again, and the most optimal consolidation will come only when you have the full picture of what is really happening in this house, but it can be done. Now, once you do that and you deflate the repayments, then you have an opportunity to then start saving. Whatever savings you make, then you from the loan repayment, then you can transition to starting having maybe an emergency fund, which is what you are lacking, and start wherever you are. And then I will also challenge this person and say, think about making additional income. We talked about starting with the building block, which is making the money. So once you made, you've looked at yourself, are you optimally using all the resources to make an income? Case in point, you are employed. I know in Kenya we are employed by one employer. We don't take second jobs, but you can take a second hustle. You can do something about your skill. You can monetize that skill so that you can then increase your earning power. Because once you've got better earning power, then these overwhelming repayments become less, because you've dealt with a major item, which is income generation. But you need a discussion. We need to look at what is really hurting and see how we can reduce that pain so that you can be able to breathe and make more money, because you don't want financial stress, which will affect your earning power. Yeah.
Okay. And do we have situations where we can actually reduce the cost of borrowing through leveraging against what you've already saved?
Absolutely. So if you have assets, for example, you have bonds, you had already invested, maybe you have a bond or you have an offshore holding with Absa or even a money market fund, it is possible for you to leverage off the investments that we are holding. You use them as lien. So again, many times women will say, we don't have assets to collateralize. So these days you can collateralize not only land, because a lot of times women will say, I don't have land to collateralize debt. You can collateralize your debt using investments that we have, including money market fund. And you can also go further, not only collateralize, but also pledge the earnings that are coming from your investment to pay back your loan. So case in point, you have maybe 100 million in a bond, and you would want to buy another asset, maybe real estate. You can use the 100 million, you collateralize up to, right now you're giving them 80%? 80%. 80%, you get 80% from Absa, that's 80 million, and you're able to buy a new asset. And remember, your 100 million bond is earning you interest every 6 months. Let's say it's 12%. So it's earning you that 12%, and the loan is maybe at 14, 15%. So it means annually, if you pledge even the 12% to be repaying back your loan, you'll only need to top up 2% or 3%. That makes it easier. It means your current asset has helped you to acquire a new asset, and your wealth building is becoming better. And I'll tell you one thing, you don't build wealth with only equity. You've got to have debt, but the right debt. So we will not finance you off your bonds to take a personal loan. We don't do that. Yeah.
Yeah. No, thanks. I think the example of 100 million
Sounds
was great.
nice.
I'm like, shall we get to that stage already where we have the 100 million to leverage? But thank you for that. And there is another question here specific to investments from Jane is, which is the high risk, high return investment option at Absa currently?
Okay, quite a bit, because, but among the unit trust funds, equity fund is our high risk, high return. I already gave you that example. If you look at its return, it will tell you that there are times it has had bad times, but the good times have been phenomenal. They've been phenomenal. It tells you the volatility, but it's not, it is managed professionally. So even when we have made a negative return, for example, let's say 2023, I think, when we made a negative return, markets were making minus 30%. You find that that fund made only minus 9%. So the professional management protects you from total failure. But after that, because the assets are fundamentally solid, then you found that asset has done very well. But if the whole market was going down, then that's why you'll find that fund sometimes going down, but definitely still with high potential to grow. Now, the other asset that you can take is, for example, offshore. We've got offshore which are anchored on S&P 500 or any of the international markets. We wouldn't say that those ones are low risk. Those are fairly complex products that we are going to give you and expose you to international markets, which have also some form of volatility, but the returns will also be, a little better. And of course, you'll have the currency hedge that you need. Now, what else can you do? Same as bonds. I know that we say bonds don't have risk, but I would like to demystify this. You can buy a long-term bond almost mirroring a property. Why do I say that? In Kenya, government of Kenya will issue bonds up to the tenure of 30 years. That means that you are lending to the government for 30 years. If it is 2026, 30 years is 2076 is when we'll, 20? No. 30 years is not 2070. 2056. 2056. That sounds like a property. I always say you compare that with a property, because if you buy a property and be collecting rent, you and the bondholder who have a 30-year paying them, say 13.5%, I'll compare that with a property. Property, you need to have you have tenants who you need to manage, you have repairs, you have, I don't know, mandamano and all that, which is affecting property, and roads which have not been made or maintained, and sewers and all that. Now, when you buy a bond on the other side, you have basically told given the government your money, and the taxes of Kenyans, including yours, is what has been pledged to pay you back. And it's, for lack of a better word, guaranteed by our taxes. Of course, there are risks to such kind of a bond, because if in 2040 you want to come and sell, just like the property you'd have built, a bond will have a price. It will either have gone up or it will be lower in terms of value, although the income that was coming from the bond is always coming in, and to some extent compared to rent, guaranteed, unlike rent. But the price of the bond goes up and down, so there's some form of risk because of the price variation that happens when we are valuing this bond from time to time. So there's also a moderate risk. That's moderate risk because the incomes are already promised and contracted. It's the price of the bond which is not contracted.
Thank you.
That helps?
Yes, that definitely helps. I think it just focuses or provides light into the risks that you wouldn't have thought. I mean, even things like government securities, where you think that everything is safe, there is an element of risk within the bonds at the point of selling any assets. Yeah, no, thank you so much for that. There is a question that came up earlier around retrenchment. I know that our products have retrenchment cover built into them, some of the products that we have. Julia, could you talk to us about that, how it works, and also what are the other retrenchment kind of solutions that are available?
Okay. Thank you, Seema. And when we talk about retrenchment, you know, sometimes when organizations are structured, and AI sometimes takes over, organizations reduce the number of employees. And normally what happens, the retrenchment cover, you've got a salary that comes through every month, And what happens, we can insure that amount of money that you make, or maybe 70%, depends on the level that somebody wants, because then there's a cost to it. So how it works is we will actually give you between 6 to 9 months, whichever you pick, of the actual salary you're earning for that period. Of course, in the hope that within at least the 9 months, you have gotten something to do. And in the retrenchment cover, sometimes people also retrench on the basis of even medical. Many things can cause retrenchment. So we will do that. So we'll be paying you on a monthly basis. And also we've got an income replace. So you find sometimes somebody is incapacitated. They've got temporary disability. So you find every week, if you're working for unemployment, every week you'll be bedridden, but your employer will continue paying your salary. But then the insurance company will be paying, but not to you. Every week they'll be paying your employer the amount of money that you should have been paid. And then there's also something called critical illness. So if you're critically ill and you had an insurance that also incorporated that, and then today you're diagnosed of cancer, or maybe you're diagnosed of diabetes the first time, then what would happen if you had a sum of, let's say, my sum assured was 10 million or 5 million, 30% of that will be paid to you immediately the diagnosis happens, immediately. So you find you can use that money for treatment. So it kind of runs, all these things kind of run together, and they are all packages, they're all packaged together to just make sure that as you work, as you do everything, then you're being protected in a way. Yeah.
Great, thanks, Julia. We're almost at the end of our webinar, ladies, but I would like to ask for one final parting shot within literally 1 minute each, and I'll start off with yourself, Gladys, and I'm being specific about 1 minute each, but just 1 minute. Tell us, or tell the ladies online, is what is the one thing that you would love for them to do from today to just change their futures?
Okay, the parting shot is, the Bible says, a righteous man leaves an inheritance for his children and his children's children. And I would want you as women to leave a legacy and not a burden for your children. And the only way to do that is to ensure that you have a proper estate plan. And if you need to talk to us, like we said, we're giving a half an hour free consultation so that we can explore what you can do and how you can ensure that you do leave a legacy for your children and not a war and battles. Yeah.
Fantastic. Thank you. Thank you, Gladys. Julia, over to you.
I'll also use the Bible. It looks like you're going that route. There's this dream that that Joseph interpreted in the Bible: 7 years of drought, 7 years of abundance. So when you have plenty, put aside for the days when your cows will be thin. So that's just insurance, basically. So let's plan, let's protect what we are strongly building. And please start today. Go back, check what insurances you have, what you don't have, and come and talk to us. We will help you craft something. It doesn't matter how much you have or how much you want, but we will craft something that will definitely protect what you're building. So please be safe, and tomorrow will be better.
Yeah, thank you. Save for when the cows are thin, ladies and gentlemen. And finally, Elizabeth, what is your parting shot?
All right, my parting shot. First of all, everybody needs to pay themselves first. Whatever stage you're at, start paying yourself. And not by having a glass of wine, paying yourself by putting it aside, postponing that consumption. 2, please don't forget to audit your expenses. Many of us are not auditing our expenses, including black tax. And black tax is real in Africa. Please audit your expenses so that you can curb on any leakages that you have. And finally, overcome the fear of risk, because if you just stay with the safe assets which are touted as sure bets, you will not multiply your wealth by the time you're aged. And we have just agreed that we may live more years after we finish working. So we need to take care of that time. Women, we need to go for holidays. So take a little more risk, dip your feet in equities, dip your feet in government bonds, some offshore, diversify, and therefore you create a long-term sort of wealth journey that takes care of you when you cannot maybe do as much as you're doing today. Thank you.
Fantastic. Thank you. Thanks so much for that, Liz. As we close, I'm going to launch one final poll for everybody to participate in, just to ensure that we have understood and taken on board the lessons shared today. After today's session, what is the one action that you plan to take? Is it to start investing, to diversify investments, take an insurance cover, review my insurance cover, create a will and estate plan, and seek professional advice on holistic wealth management? Second one is, we love to be bringing these webinars to you more often, and so therefore would love to also hear what you would like to hear about. So would you like us to focus on creating additional income streams, a masterclass on estate planning, which I can see is already popular, insurance planning that every woman should know about, look at wellness, what are the things that you'd like to look out for there, and also navigating life transitions. Remember, we really want to ensure that we empower all ladies to be able to attack or look after all sorts of elements that impact them, be it from a financial wellness perspective, mental wellness, and also just general well-being, again, which covers everything. So I can see that the thing that seems to be popular is creating additional income streams and having practical investments, and then estate planning. So we will be looking into that and promise to bring you more over here. I think on the first question, holistic wealth management still seems to be the more popular choice, and that basically does cover everything that we've spoken about anyway today. So as we come to the end of today's webinar, I'd like to thank the panelists again. You've been fantastic. I think there have been some really heartfelt comments that I've been reading on the chat about our panel of expert women. It's lovely to see women take charge, especially for conversations as important as this. And I hope that all of you have found that the conversation today has not only been about money, but has been about a holistic view around securing your future. So how it is, first of all, to build it, second of all, protect what matters most, and third of all, ensuring that you actually leave what you worked so hard to build to the next generation to come in the manner in which you decide, and not that somebody else decides for you. At Absa, we're really committed to be here hand-holding you through this journey. Thank you again so much for your time. We really hope that you've enjoyed the panel of experts today. Again, thank you so much to the panel of experts. And looking forward to catching up with all of you at the next webinar. Thank you again so much, and wishing you a fantastic day.